Please refer to page 3. The next issue we're going to discuss will be AS7, Statement of Cash Flow. Please refer to page 202, AS7, Statement of Cash Flow. For HKAS7, Statement of Cash Flow, SOCF. The first issue we have to look at will be objective of Statement of Cash Flow. For a company to survive, besides profitability, the company need to look at their cash movement. A company at profit without cash, it may not be able to survive, especially when the market conditions are uncertain. If a company at profit no cash, as compared with cash no profits, I believe no cash have profits will be more severe. The best is they have cash and profits. In order for financial statement to be complete under AS1, a company must produce statement of profit and loss, statement of financial position, statement of changes in equity, and statement of cash flow. Statement of cash flow is one of the important components of financial statement. The preparation of statement of cash flow will be under AS7. When we talk about objective of statement of cash flow, at the same time we need to know what are the differences between statement of profit and loss versus statement of cash flow. Generally, statement of profit and loss is based on accrual concept. Statement of cash flow is based on cash concept. When we prepare the statement of cash flow, we have to consider only the cash inflow and cash outflow. Whereas for statement of profit and loss, whether the company earn or not will affect our profit and loss instead of when the money is received. Let's look at a few examples. The statement of profit and loss for 31st December 2019 as compared to statement of cash flow for 31st December 2019. Take for example, when there's a sales of goods on 1st December 2019 for $50. If this transaction is on cash term, this will affect statement of profit and loss. This will affect statement of cash flow. If it's a cash term, it's a cash sales. If this is a credit sales, this will affect profit and loss, but the statement of cash flow is upon receipt. We need to know when we receive the cash from the sales of goods to customer on credit term. If the cash is received from customer in 2019, then it affects the statement of cash flow. Otherwise, it will affect 2020. Take another example. Purchase of PPE for 200 on 1st Jan 2019 with useful life of 4 years. Assuming a very simple transactions, we need to know how this affects our financial statements. In the statement of cash flow, immediately reduce in cash on 1st Jan 2019. But in the profit and loss, this will give rise to depreciation expense of $50 over 4 years. Profit and loss is based on accrual concept. Statement of cash flow is based on cash concepts. When we prepare statement of cash flow from statement of profit and loss, we have to consider the difference in terms of accrual concept and cash concept while making the adjustment. The second issue is the formats of statement of cash flow. One format, but two methods. Let's look at the notes now. Please refer to page 204, the format of statement of cash flow. In accordance to AS7, we need to identify what is the cash at the start, what are the cash at the end, what are the movement. And from this movement, increase or decrease, we need to identify how much cash is from operating activity, those cash from the ordinary activities like cash payment to supplier, cash payment to employee, the cash receipt from customer. In this case, it's equal to 7. We also have to show the movement from cash from investing activity, the money used to purchase machine equipments, the money we use to purchase share in another company, the money we receive from disposable sales of non-current assets. In this case, it's a negative outflow of 12. At the same time, we are required to show the cash from financing activity, the issue of share for cash, the issue of loan for cash, the redemption of loan by using cash. In this case, is $14. The total of these three represent the net cash increase during the year, plus the cash at the start of the year equals to the cash at the end of the year. Only one format. Cash from operating activity, cash from investing activity, cash from financing activity. However, there are two methods to calculate the cash generated from operations. One is direct method. The other is what we call the indirect method. Direct methods means we calculate the cash directly. Cash from customer, 99, cash payment to supplier, and how much cash payment to employee. So this is easy to understand. Another method is to use what we call the reconciliation method. It's to reconcile profit before tax to a cash generated from operation. We calculate the cash generated from operation indirectly. To understand this method, we need to understand how the figure is being determined in the first place. Profit before tax is from the profit and loss statements. This $7 include cash and non-cash item. Cash item means the cash received from customer for the sales made during the year. Non-cash means the credit sales made to customer during the year but the cash may be received in the following year. Purchases made but make payment in the following year. These are considered cash and non-cash. The $7 also includes operating and non-operating. Operating are referring to the transaction in the ordinary course of business, like sales and purchases during the year. The transaction will be reflected in the profit and loss. Non-operating are referring to like interest income received, interest expense during the year, the gain or loss on disposal of non-current assets, the changes in fair value of investment property. All these are considered as non-operating item. Whereas cash from operation is only cash plus operating item. When we do the reconciliation from $7 to $20, what we need to do is very simple, is to remove the non-cash and non-operating item. Take it out, plus minus. Normally the adjustment that you will come across, like for example, the depreciation. The depreciation is inside the profit and loss. We purchase the machine, we use the machine over the 4 year, every year we charge $25. So $25 is inside the profit and loss. But the depreciation is a non-cash item, so you must take it out. In the profit and loss you minus, now you take it out, you have to add it back. Other examples are things like forex exchange losses, investment income, interest expenses. All these are considered non-cash, non-operating item. What you need to do is to take it out. For examination purposes, normally the method they use will be the indirect method. You must get yourself very familiar with what is the indirect method on this sort of adjustment. Whatever method we use, at the end of the day, the cash generated from operation will be the same. From this line onwards, everything will be the same. Direct and indirect method is only affecting how we calculate the cash generated from operations. It does not affect any figure from there onwards. Another issue we have to consider is, what's the meaning of cash equivalence? If this is considered as cash equivalence, it will be part of opening and closing cash balance. If it's not cash equivalence, then this will be part of investing activity. Take for example, short-term investment. This short-term investment last year is equals to $6. This year, the short-term investment is equal to $8. We need to know whether this is considered as cash or cash equivalent. Is this cash or cash equivalent? If the answer is yes, then it will be part of the opening and closing cash. Meaning is that opening cash will be $6, closing cash will be $8. During the year, cash increased by $2. If the answer is no, that means during the year, we use cash to buy investment. We bought investment $2, our cash reduced by $2. So it's important to know whether this investment is a cash equivalent or not. How do we know it's cash equivalent or not? We'll look at the definitions of cash equivalent. In order for us to call this as cash equivalent, it must be a short-term, highly liquid investment that can be convertible anytime into known amount of cash that is subject to insignificant change in value. Take for example, investment in share of HSBC. For example, we acquired a share of HSBC with intention to sell in 3 months' time. And if you sell the share, someone is willing to buy, it can be converted in cash within 3 or 7 days. So is it considered as cash equivalent? The answer is no, it's not considered as cash equivalent. Because investment in share is subject to significant change in value. In order for us to call this as cash equivalent, it must be short-term, highly liquid, convertible into known amount of cash that's subject to insignificant change in value. Normally investment in share, we do not call this as cash equivalent. The standard gives us some guidance. In order for an investment to be considered as cash equivalent, investment with short maturity, which means it must be investment like deposit, bond. Short maturity, 3 months or less from the date of acquisition. If the answer is yes, then we consider as cash equivalent. They'll be part of the opening and closing cash balance. So in the exam, when we talk about short-term investment, is it considered cash equivalent? Anywhere in the question give us any indication that is short-term, highly liquid, convertible into known amount of cash that's subject to insignificant change in value. If the answer is yes, then we treat this as cash equivalent, as good as cash. Otherwise, it's part of investing activity. The fourth issue for statement of cash flow, we have to determine the missing figure. In the exam, you'll be given most figure, but not all the figure. When there's any figure that's not given, we have to calculate this missing figure based on double entry concept. Normally in exam, you'll be given a statement of profit and loss, other comprehensive income, statement of financial positions, sometimes it's statement of changes in equity, and definitely they'll give you some notes. From whatever given to us, we need to prepare the statement of cash flow. During the process, we need to know the format, which is not an issue because it's an open book exam, but you cannot treat this as open book exam. If every question refers to books, you don't have time to answer all the questions. You must treat this as closed book exam, even it's open book exam. So you must memorize the format. All this must be at fingertips. You must understand all this within seconds. Number 2, you must be able to calculate the missing figure. The best example is to look at PP. When we calculate the missing figure for PP, first we need to know what's the opening balance. For example, at the start, we have an opening balance of equals to 50. At the year end, we have a closing figure of 70. The opening and closing figure is from statement of financial positions. When the question wants us to prepare the statement of cash flow, or consider a factor when preparing statement of cash flow, the information given to us, statement of profit and loss, statement of financial position, statement of change of equity, and the notes, whatever information given to us, there's only 2 types of information. One is the opening or closing balance. Take for example, the opening balance for PP and closing balance for PP. After that, they also give us some transaction during the year. Transaction during the year, you have to think about the debit and the credit. Which account is debited, which account is credited. Take for example, PP. Normally PP, you have to think about AI 16. During the year, there's a revaluation surplus. The revaluation surplus will be part of OCI. The revaluation surplus will increase PP $8. If it's a revaluation loss, you minus. During the year, there's a disposable of PP. As a result of disposal of PP, we must remove the PP to calculate the gain or loss. For example, disposable, you should minus $6. During the year, transfer to investment property. For example, you have a property. In the past, we used the property ourselves. Now, we use the property for rental income. We must transfer from PP to IP, so you have to minus $5. And during the year, depreciation profit and loss is equals to 17. After putting all the plus minus, when we talk about plus minus, it means the debit and credit to this account. There will be a balancing figure in this case. equals to a plus of 40. If the question is silent, I assume this is considered as additions. During the year the company increased the PPE, we need to know whether this increase of PPE is cash or non-cash. If it's non-cash, the question has to tell us. Otherwise, it's cash. This approach. First, we must put in the opening and closing balance from balance sheet. The movement you need to know from the profit and loss, from the OCI, and also from the notes. After that, you calculate the balancing figure. This is the missing figure that we are talking about. Sometimes they want us to calculate the depreciations. Then they must give us the addition, vice versa. This is the approach. After we calculate the missing figure, this cash amount will go to your statement of cash flow. This entire process when prepare the statement of cash flow. Please refer to page 211, question 4.2, a Module A questions to discuss the preparations of statement of cash flow for the group. Study questions, understand the issue. We're going to discuss this question shortly. Assuming you are the accounting manager of PJL, you are required to prepare a memo in response to the question raised by CEO Wong in relation to the consolidated statement cash flow for the year end 31st December 2017. 11 marks. You are required to do a memo. Format will be around 1 marks. Then the other 10 marks will be on the accounting issue. This type of question is relevant to Module 11. Part B, you are required to prepare the consolidated statement cash flow using indirect method. You are given instruction to use the indirect method. We study the information given to us now. PJL is a company listed on the main board in Hong Kong, engaged in the manufacture and distribution of jewelry. PJL and its subsidiary have a financial year end of 31st December. In 2016, that was last year, PJL acquired 35% interest in AGL, and this year on 1st Feb 2017, PJL acquired 80% of STL. Unless the question indicates otherwise, I would think this is considered as an associate, whereas this 80% will be considered as a subsidiary. Subsidiary is acquired in 2017. A newly acquired subsidiary, the effect of cash flow. Associates acquired 2016 last year. We do expect sharing of associate profits, and we may receive some dividend income from associate. We're given the draft consolidated statement of profit and loss. This is just an extract. We are not given the revenue. We are not given the cost of sales, and so on. If you are not given the revenue and not given the cost of sales, we cannot use direct method. In order for us to use direct method, we need to know the revenue for the year, the cost of sales for the year, the operating expenses for the year. For this question, we must use indirect method. When we prepare the statement of cash flow using indirect method, we always start from this line, profit before tax, 553. We'll come back to this later on. This year we share of associate profits, 105. This is a non-cash item. This share of profits using equity method is a double entry. It does not involve cash. The total profit for year is 404. Out of this 404, 30 belong to NCI, 374 belongs to the parent. Whatever contained in the profit and loss is considered as transactions for the year. You have to consider the debit and the credit. We'll look at this later on. We're also given the consolidated statement of financial positions at 31st December 2017. Last year and this year. Information contained in the balance sheets represent balances. Last year balance is this year opening balance. We need to consider the movement. Like for example, building last year is 890, this is 890, there's no movement. The accumulated depreciation last year is 230, this is 267. There's an increase in accumulated depreciation, normally it's due to depreciation. This is the adjustment for the year. This depreciation should be in the P&L. Machinery, last year is 420, this is 900. There's an increase in machinery. We need to know why is the increase in machinery, cash or non-cash. Goodwill, last year is 0, this is 30. Goodwill increased only for two reasons. One reason is because of acquisition of new subsidiary. Another reason is because of translation gain. But for this question, they did not mention about translations. This increase should be acquisition of new subsidiary. And goodwill is not a cash item. We're going to use all this figure for part B when prepare the consolidated statement cash flow. For balance sheet, we need to know this is the brought forwards, this is the carry forwards. Last year our cash balance is equals to 546. This year is 1355. You appear our cash increase. We want to explain why is there increase. Notes 1. The cash and bank deposit in 2017 includes $700 of bank deposit with more than 3 months to maturity when placed. And last year, $400, more than 3-month deposit from the date of placement. In this case, these two are considered as non-cash or non-cash equivalent. In accordance to AS7, for cash equivalent, it must be short-term deposit with a maturity date of 3 months or less from the date of investment. This question, it mentioned there's more than 3 months to the maturity when placed. This is considered as non-cash equivalent. So we must take it up when we prepare the statement cash flow. Number 2, there's no change in the fair value of financial assets measured at fair value to P&L. No change. For this question, there's no plus minus in P&L. Number 3, there have been no acquisitions or disposal of building during the year. However, the machine costing 160 was sold for 150, resulting a gain of 30. This is a transaction during the year. If it's transaction during the year, we have to consider the double entry. New machinery was acquired in 2007. We need to know these acquisitions, how much cash or non-cash. Out of this acquisition, the question mentioned non-cash is 235. This is non-cash because acquire new machinery by arranging lease transaction. Debit RU assets, credit lease liability. This 235 is a non-cash. The balance should be cash. We need to know what's the balance. And during the year, there's a disposal of machinery. This is the transaction for the year. We have to think about double entry. The cost of this disposed item, 160, and sold for 150 with a gain of $30. The proceeds is equals to 150, sold for a gain of equals to 30. The carrying value is equals to the difference between these two. 150 minus 30 is equals to 120. If the carrying value is 120 and the cost is equals to 160, in other words, the accumulated depreciations at the date of disposal should be equals to 40. This is the entry that the company passed. Now for statement cash flow, what must we consider? The gain of $30 will be recognized in P&L, and the cash flow is the 150. The rest are just movement during the year. Number 4. In relation to the acquisition of STL, we are given the following. This represents the fair value of net assets acquired. This represents the cost of 80%. And this represents the NCI of 20%. We take 88 plus 19 minus 77. The goodwill is equals to $30. The cash item is cash paid to acquire the subsidiary is equals to 4. This represents the cash outflow. After acquiring the subsidiary, the company controlled the cash of 34. This is considered the cash inflow. The net cash flow to the group is equals to $30 inflow. This represents the cash inflow for the group as a result of acquisitions of STL. We'll come back to this shortly. Classification of cash flow. After reviewing the consolidated statement cash flow, the CEO of the entity, Wong, raised a question in relation to the classifications of various items presented in statement cash flow. She asked for explanation on the following. Bank deposit pledge for long-term loan were not included in the cash and cash equivalent. Why? Because it does not meet the definition of cash and cash equivalent. Especially cash equivalent, it must be short-term investment, highly liquid investment, can be convertible in known amount of cash subject to insignificant change in value. In order to meet these definitions, normally it must be an investment with short maturity, 3 months or less from the date of investment. This bank deposit pledge is considered as restricted. That means the company cannot use it freely. And moreover, this pledge deposit is considered as more than 3 months from the date of the investment. This is not cash equivalent. This will be part of the investing activity. Number 2. Cash consideration received for the disposal of share in subsidiary that do not result in loss of control were not included under the investing activity. When there's a disposal of share that do not result in loss of control, it only affects ownership of subsidiary, affects NCI, which means this is considered as an equity transactions. But if it's an equity transaction, it's considered as financing activity. Number 3. The purchase and sales of security that are held for trading purposes are not classified as investing activity. Why? Security for trading purposes, this is considered as part of operating activity. It's not part of investing activity. Number 4. Financing and investing cash flow to the same institution were not reported on net basis. Why are we not reporting on net basis? Because these are transactions relating to the activity of the entity. it does not meet the criteria to show on net basis. When we're dealing with the same institutions relating to the activity of the entity, like for example, you get a loan from Bank A and we invest in certain product of Bank A, this is the activity of the entity. If it's an activity and entity, you must show a cash inflow, show a cash outflow. There are certain transactions that you must show on net basis, like for example, principal and agent transactions. The company is acting as an agent. I receive $50 from customer on behalf of the principal. I receive $50, I have to pay the principal $45. I will show a net cash inflow of $5 because this is a principal and agent transactions. Deferred consideration in relation to acquisition subsidiary that was paid in the following year was not classified in the operating activity. This is considered as acquisition of subsidiary if acquisition of subsidiary is considered as investing activity. Can we answer part A now? We are required to do a memo, and this memo is 11 marks. For 11 marks, 1 mark is on the format, and the other 10 marks will be on these 5 issues. Each issue will be around 2 marks each. A. We are required to do a memo. You must have proper format of memo. To CEO Wong, from you accounting manager, the dates, the subject, and the simple introductions, and we start to explain the issue. The first issue is the pledged bank deposit. In order for us to show a cash and cash equivalent, we must meet the definition of cash and cash equivalent. We have to highlight this main point. In order for us to call this as cash and cash equivalent, especially cash equivalent, it must be short-term, highly liquid investment that are convertible into known amount of cash with subject to insignificant risk of change in value. In accordance to AS7, an investment normally meet the definition of cash equivalent only when you have short maturity of 3 months or less from the date of investment. The pledged deposit do not meet the definition of cash equivalent because there's restriction in using the deposit and the maturity date is more than 3 months. In this case, it does not meet the definitions of cash and cash equivalent, so it should not be included in cash and cash equivalent. Instead, this will be part of the investing activity or financing activity according to the nature and intention of the underlying transactions, but definitely is not considered as cash and cash equivalent. Number 2. The changes of ownership in subsidiary that do not result in loss of control. These type of changes affect the ownership of the subsidiary. It affects the changes in the interest of NCI. It's an equity transaction. If it's equity transactions, it will be part of the financing activity. In accordance to AS7, the changes in ownership in a subsidiary that do not result in loss of control should be classified as part of financing activity, unless the subsidiary is held by an investment entity and is required to manage a fair value through P&L. But this is not the case here. Changes in ownership in subsidiaries do not result in loss of control. For example, from 80% reduced to 70%, drop by 10%, this do not affect control. This represents equity transactions. If it's an equity transactions, the resulting cash flow should be classified in the same way as other transactions. It only affects ownership. Generally, will be part of financing activity. Number 3, security held for trading. An entity may hold security for trading purposes. This is like any other current assets like inventory acquired for the sales in the ordinary course of business. So in this case, this will be part of operating activity. It's not investing activity. Number 4, reporting financing and investing cash flow on a net basis. In accordance to AS7, the entity should report separately major class of gross receipt and gross payment arising from investing financing activity, except to the extent that the cash flow described under paragraph 22 and 24, which may be reported on net basis. For example, I'm acting as an agent for a third party. I receive $50, I have to pay the third party $45. I'm acting as an agent, so I will report a cash flow of $5. These are activity for a third party. This is not activity for the entity. If it's an activity for the entity, then it must show on gross basis separately. In this case, financing and investing activity of the entity should be reported on gross basis, not on net basis, unless meet the criteria under paragraph 22 and 24 of AS7, which is not relevant here. Number 5, deferred considerations in relation of acquisition of subsidiary. We acquire the subsidiary now, but we make payment for the investment much later, a deferred consideration. A deferred consideration is part of investment cost. So it's part of the investing activity. Deferred payment in relation to acquisition of subsidiary that was paid in the following year should not be classified as operating activity. This is part of the investment cost. This should be part of the investing activity. Remember, you must give a closing. For part B, we are required to prepare the statement of cash flow for the group. But before I look at part B, I do want to do part C. Prepare disclosure note for acquisition of subsidiary, SDL for this year, relating to cash flow. If you know how to calculate goodwill, you should know how to prepare these disclosure notes. Just need to copy these portions and put it here. This is the fair value assets of SDL at the acquisition date. On top of that, we must consider the goodwill. The goodwill based on the question is equals to 30 to less the NCI 19. 77 plus 30 minus 19 equals to 88. This 88 represents the total considerations for the 80% of the parent. Out of this $88 million, non-cash considerations. The non-cash consideration is issue of share, 84. This is the issue of share. Debit investment credit share capital is a non-cash consideration, 84. 84. The balance is considered as cash